Welcome back to Withum's video series, The Alternative Route. Here with me today is Robert Crea, partner and U.S. Head of Fund Formation at BCLP. Robert, thanks for joining us today.
Great to be here.
So today we're going to dig into the venture capital advisor exemption, such an important area with nuances that really are critical for emerging managers to be aware of. So let's start off with a little bit of background on how it came about. Can you tell us the political and historical background behind the venture capital advisor exemption, and why did Congress decide to treat VC advisors differently from other private fund managers?
Sure, it's a great question. And the VC advisor exemption was adopted in 2010 as part of the Dodd-Frank rules. And so what happened at that time, as you might recall, this was after the global recession. There was the economies across the world had tanked, and there was a lot of concern about systemic risk. And in Dodd-Frank, they altered the regulatory exposure for investment advisors broadly. And as part of that, there was a VC advisor exemption that was statutorily created by Congress with an instruction to the SEC to create a specific rule defining terms and how the exemption would apply. VC advisors at the time had very effective political lobbyists and had persuaded and convinced members of Congress that they did not pose any systemic risk because they weren't leveraged, that they were also job creators. And in contrast to, say, private equity, for example, they were not heavily leveraged, and they were not, which was often kind of described at the time, that private equity was highly leveraged, it was job destructive, whereas venture capital was entrepreneurial and job creating. And so in that context, the venture capital industry managed to succeed in getting this very special federal exemption that was applicable to it.
So now knowing that, what's actually at stake when a manager relies on the exemption, and why do you think some managers, including some of the most prominent venture capital firms in the country, choose to register as an investment advisor anyway?
Well, the exemption is very powerful insofar as it saves a venture capitalist from having to be burdened with the full panoply of obligations as an SEC registered investment advisor. So that means, but it's not registration light. So VC advisors still should have a code of ethics and some very minimal compliance policies and procedures. But it's also a very limiting exemption that a VC advisor has to only advise venture capital funds, which is a very defined term. As part of that defined term, there are certain qualifying investments, and you can only participate in non-qualifying investments up to a very limited bucket. So some of the very prominent and successful venture capital firms that are out there have decided that trying to maintain the exemption as a VC advisor and avoiding full registration with the SEC creates more burdens than there are benefits to its business. So for example, if a venture capital advisor wants to create a private fund that focuses on digital assets, or if it wants to create a fund that invests a significant portion of its assets in secondarily acquired securities, or let's say there's some interest in actually leveraging a fund. A pure play venture capital advisor that seeks the exemption wouldn't be able to do those things, whereas a more prominent, very significant venture capital advisor that does seek to do those kinds of things can do so if it is fully registered with the SEC, but generally can't if it is seeking to preserve the venture capital advisor exemption.
That makes sense, and especially with the growth in the secondaries market year over year, I can see how this pops up. The exemption requires the advisor act, as you mentioned, solely as an advisor to venture capital funds. So what in practice does that really mean, and where do you see emerging managers getting tripped up with that?
So one of the definitions, so as part of that definition of venture capital fund is that 80% of the assets have to be so-called qualifying investments. And a qualifying investment is described in part as an equity investment that is directly issued by a portfolio company. So a secondarily acquired equity interest in a portfolio company, for example, wouldn't qualify because it's not directly issued by the portfolio company. And so in this context of what you just described about secondary investments. That doesn't qualify. And so if you're an emerging manager and you're trying to hunt for deals, there is a great temptation, especially if you find an allocation on one of these secondarily acquired shares in a really compelling pre-IPO company. And the catch is you're still investing in a pre-IPO company. You're just not making the direct investment. However, from the regulatory perspective and the definition of what is a venture capital fund, if you create a venture capital fund that makes that investment, it's not going to be a qualifying investment, and thus your fund might not, in fact, be a quote-unquote venture capital fund if that value of that investment exceeds a certain percentage of the assets of the fund overall. Where I have seen this in my practice come up as creating problems, for example, is you could have let's say you're a fund sponsor and you have multiple venture capital funds that all meet the definition under the exemption as a venture capital fund. And let's say as you're going about your daily business, you come across an opportunity to invest in secondarily acquired shares in, say, Anthropic. That's a great investment. You might want to do it. And so let's say you create a single purpose vehicle, SPV, to make that investment. Let's say it's only, say, a $500,000 investment, whereas you might have like $200 million in regulatory assets under management. So you make that $500,000, you spin up the $500,000 SPV, you acquire Anthropic shares on a secondarily acquired basis. Well, just by creating that one vehicle, even though it's a small fraction of your overall business, you've now blown your exemption for your entire regulatory infrastructure. And what that means is that instead of now benefiting from being a venture capital advisor under the exemption, you're now on the path to actually fully fledged registration with the SEC. And you may have an issue where if you actually have in excess of the $150 million threshold, which is under the alternative private fund advisor exemption, you may have a situation where you are retroactively having to register as an investment advisor, which is as opposed to just transitioning into becoming a registered investment advisor. And that can pose some compliance headaches and some questions from the SEC as well.
It sounds a little bit like a fire drill scenario.
Definitely is.
What kind of limits does the exemption place on fund level leverage?
So the leverage that, and again, this kind of comes back to, there was this discussion at the time of Dodd-Frank, which was trying to distinguish between what is the venture capital industry versus what is the private equity industry. Private equity, which is heavily using leverage, doing LBOs and things like that, whereas venture capital is supposed to not be presenting systemic risk. And so the leverage limitations that are under the venture capital fund advisor exemption basically says that every single one of your venture capital funds that you manage can't have leverage in excess of 15% of the commitments to the fund, and the tenure of the debt cannot exceed 120 days. So those limitations were very specific to the context of allowing subscription lines, basically borrowing money against your uncalled capital to be able to facilitate just the day-to-day operations of the fund. That is permitted, but broad leverage on the fund altogether and broad leverage of the underlying investments of the fund, that is not permitted. But there's also a catch here on this leverage. And so this is one area where emerging managers can sometimes make a mistake, which is some subscription lines might include renewal provisions, and the requirements under the venture capital advisor exemption specifically state that it is non-renewable.
Certainly a lot of detailed definitions in there that could make or break the qualification for the exemption. From your perspective, like with the managers you've worked with and seen over time, what's the biggest misconception or the biggest pitfall you see people falling into that they should really be monitoring closely?
Well, I think the biggest pitfall is the secondary issue, because this is in at least just in our present state and time, in the venture capital industry, some of the most compelling opportunities are secondaries. And so, especially for emerging managers who are hunting for good deals, secondaries are a great temptation, and that's what poses the greatest risk to actually maintaining the exemption if you want to maintain it. I think another thing to think about is that the venture capital advisor exemption is a federal exemption. And the way that the regulatory infrastructure works for private funds is, yes, you have to look at what the federal government requires, but we live in a federal system with 50 states. And many of the 50 states have their own private fund advisory exemptions, and many of which also have specific venture capital advisory exemptions that largely mirror what is the federal exemption. But you have to be sure that if you're creating, say, a new venture capital fund complex as a new venture capital advisory exemption, and you are planning on relying on the federal exemption, you also need to look at what your state requires and make sure that your state also has a corresponding venture capital advisory exemption. And if it doesn't, then what are the state requirements that you may be obligated to follow, and does that actually correspond with what you were originally thinking about as your plan for exemption vis-a-vis the federal government?
It kind of goes back to what you said earlier, of whether the benefits of the exemption outweigh the burdens of complying with it.
Correct.
Robert, thank you so much for walking us through the nuances of the venture capital advisor exemption, and thank you for joining me today. Stay tuned for our next episode of The Alternative Route.